8/11. We move on to the balance sheet and notes. Remember, the balance sheet reflects the position of a business as to date. Now, before we move into the balance sheet, we will move in by looking into the fixed asset note. The fixed asset note. Again, I repeat by saying we cannot overemphasize formats. So it's important for yourself to test yourself now and then on the formats of your balance sheet, starting from the notes. Once you know your formats, then all other things will fall in place. All right. So for the fixed asset note, we will use again the November 2016 paper. Again there, it is based on 3.3 fixed asset note. So this is what we will be doing. Then the most important thing that I like to emphasize is you need to know the financial year. It ended there, and when did it start? If it ends February 2016, it means the start will then be 1st March 2015. Now, let's move to the fixed asset note. The fixed asset note, remember here, it's only fixed assets that are catered for in here. Right? Then here you start with your carrying value on the 1st of March 2015. It was slotted in for you. Right? Then the carrying value for vehicles is unknown, and for equipment it's unknown. But then we need to go and look at information with regard to cost price and accumulated depreciation. Then everything happening here it is at beginning. Everything happening from movements until the carrying value there, or from movements until before the carrying value there, this is now during your financial year. All information pertaining during the financial year we put in here. Then from the carrying value until accumulated depreciation at the end, all the information there is with regards to end. Right? So when we look into our set of information, we break it down in the following fragments or segments. Now we need to go and check our cost price at the beginning was given to us, and the vehicle's cost price at the beginning was also given, but the equipment one was not given. Therefore, we need to go and check in the trial balance. So in the pre-adjustment trial balance, remember now we do balance sheet, so our focus will be on the balance sheet section. Then we look for equipment. They say on the 1st day of March 2015, equipment is 245,000. So that date warrants me that this balance is at the beginning. If the date was not put in there and you only have 29 February with no additional information telling you that this is balance at the beginning, then you'll automatically take it to the end. But now in this case, they've indicated to us it's on the 1st of March, therefore we take it as it is and slot it in there, 245,000 as our balance at the beginning. Then now the accumulated depreciation on land and building will be not for now, so it has no effect here. Then we have the accumulated depreciation for vehicles. We need the accumulated depreciation for equipment. Again, go to pre-adjustment trial balance. We look for accumulated depreciation on equipment. There, they've given you as 95,000. All right. So the 95,000, we will then slot it in as our accumulated depreciation at the beginning. All right. Then remember, we need to indicate it in brackets. So the difference between the two will then give us carrying value. When you say 245,000 minus 95,000, then we will have a carrying value of 150,000. If we also do the same there, we will get then a carrying value of 302,100 rand. That is then our carrying values. So how do we get carrying value? It is your cost price minus accumulated depreciation. It equals then carrying value, or it equals then your book value or your diminishing balance method, or your diminishing balance. Right, so we're done with the first part of the fixed asset note. Now we go to movements. Now movements we think about during the year. What happened during the year? Did I buy new land and building, vehicles or equipment? If so, then we will call it additions. And these additions are additions at cost. That will then be additions at cost. So the additions at cost, we need to go and check under the information. When we look at the information, number 13, they say new storeroom was built during the year the transaction was fully recorded. So let's go and check. At the beginning, we have 520,000 as our cost price there. At the end, we have 850,000, which means moving from there to that one, we have added something there. What did we add? So we can do the following. Take this end balance 850, subtract it with the 520, then you will be able to get additions. Meaning we'll say 850,000 subtract the 520,000, then the difference between the two should then give you 330,000, and then 330,000 is your additions there. It means that was the value of that new building. The cost price at the end and the cost price at the beginning subtracted, it will give you the additions of land and building. Then when we look into vehicles, let's look for the information where they indicate whether we've bought new vehicles. Under adjustment number 14, let's say take note new vehicle of 180,000. So there's the answer. Was bought. So under additions there, we bought 180,000. Right? Then for equipment, we need to go and check under equipment what happened. Under equipment, they just say old equipment was sold. So there we did not buy anything. So it's a not there, or you can put the dash. We have only bought land and building and equipment. Done. Remember, it's still during the year, and it's additions we bought. Then we need to check during the year, did we sell any assets? And that one will then be disposal of assets. So the disposal of assets or asset disposal will come in here. Right? Remember, as per adjustment number 12, they say old equipment was sold on credit for 45,000. The fixed asset register showed the following entries concerning the equipment. The cost price of it is 80,000, which means now the disposal, we start with the cost price of the sold asset. The cost price of the sold asset amounts to 80,000, right? Then the disposal here, what's very important to take note of is disposal at carrying value. So it is at a carrying value. So here we need to work out the carrying value. And remember, how do we work out carrying value? We said there's the cost price, subtract the accumulated depreciation, it will therefore give you carrying value. Now, what cost price are we going to look at? The cost price of the sold. We have it already there. Then we need now to put in the accumulated depreciation of sold asset, right? Of the sold asset. In this case is equipment, right? In this case is the equipment, right? So the equipment that we have sold, it had accumulated depreciation of, when we look into our information, it is the 32,000, right? So we will start off by saying is the 32,000 plus the depreciation which we will work out for the current year. And the depreciation for the current year, when we look at the information, they say, okay, equipment is 10% per annum on the diminishing balance. Now, we quickly need to work out the depreciation for that. So the depreciation on the equipment will then be, on the diminishing balance method, it will then be cost price subtract accumulated depreciation, then we say times rate times the time we used it, it will give us depreciation. Now what is the cost price of the sold? 80,000 rand. Then the accumulated depreciation we have at the beginning is that 32,000. So subtract the 32,000, multiply by the rate they said to us is 10%, multiply by for how long did we use it before we sell. They say it was sold on the 31st of December. So we count from 1st March 2015 until December. Right? It gives us about 10 months. So the depreciation there, when we work it out, must give you 4,000 rand. So we have the depreciation for the current year. We have now the depreciation of the previous year. Add them together. So once you add these two together, it gives you then the accumulated depreciation on this particular equipment, which should then be 36,000. All right? So it should then be 36,000. All right? So where are we going to? We are working towards carrying value of the disposal. So the disposal, we said cost price of the sold asset, the cost price is 80,000. Accumulated depreciation of the sold asset, we had the one at the beginning. We did not have this one. We worked it out as per the information, we got it, and we put it in there. So the total accumulated depreciation is then 36,000. Now we need to subtract it in order to get carrying value. So the difference between the two must then give you the disposal at carrying value as 44,000. So this is the disposal at carrying value. Now that answer is what we put in there under equipment, disposal at carrying value 44,000. Then it's important to put it in brackets to show that this vehicle is, this equipment is decreasing. Right? So disposal at carrying value. These are the steps you follow to get carrying value. Cost price minus accumulated equals to carrying value. Then you have your carrying value. Right? So the next movement, we did not sell any equipment. Right? So there was no equipment sold. So there's nothing. We did not sell any lentil building, nothing. Then under movements, we need now to work out depreciation as well. Which depreciation? Depreciation for this year. We need to work out depreciation for this year. Alright, we start by saying depreciation on a working page. We start with the depreciation on vehicles. Right? The first step will be we do the depreciation on the remaining vehicles. Alright? The remaining vehicles, let's go and check on the information. On the information they tell us equipment we have vehicles we have 448,000. So the vehicles we have 448,000. Then which method are we using? On vehicles, we use 15% per annum on cost price. Right? So which means it's the cost price method. If it is the cost price method, it means it's cost price times the rate of depreciation times the period you use that particular asset. It will give you depreciation. So that's the formula we'll follow. Now let's start by saying, okay, let's look at the other additional information regarding vehicles. Take note, new vehicle of 180,000 was bought on 1st September 2015. This was not recorded by the bookkeeper, which means we need not to minus it from the beginning balance of vehicles we have there. We can use the 448,000 as it is, then multiply by the rate. They said the rate is 15%. Multiply then by the period we had these vehicles. It's for a full year because we did not sell them. Then the depreciation is 67,200. From there we move and do the new vehicle. New vehicle, as per our information, they indicated to us we bought a new one, 180,000. So we'll write the 180,000 there, multiply by, the percentage is still 15, multiply by, we need now to determine for how long did we use this vehicle before. Right? So 180,000 was bought on 1st September. So 1st September, we will count from here until 28 February 2016. So when you buy a new one, you count from the beginning where you bought this particular asset until the end. From the beginning where you bought it until the end. So from 1st September to 28 February 2016, when you count down your months, or when you count your months, it should give you then about 6 months. So when you do the working there of your depreciation, it should then be 13,200. All in all, the depreciation on your vehicles should be the total of these two. And then that total amounts to 80,700. Go to depreciation. Land and building, for now, your syllabus, it does not depreciate. Vehicles depreciated with 80,700. How did we get the 80,700? We said on our working is the depreciation on the remaining vehicles, the depreciation on the new vehicles. That's the total, transfer it in there. Now we need to work out depreciation on equipment. So when we go and say, okay, depreciation, we work it out on equipment now. First thing is to determine which method are we using. Here they say the diminishing balance method is in use. Remember we said the diminishing balance method will then be cost price minus accumulated depreciation. Then we can say times the rate times the time we used it, we get depreciation. Right. So let's start with remaining. We go and look into our equipment from the pre-adjustment trial balance. The equipment in there, it's 245,000. So the 245,000 is our cost price. Then we check, did we sell any of our equipment? when we look into the information, adjustment number 12 indicated to us that on the 31st of December, we sold an equipment with a cost price of 80,000, which means we need to subtract that 80,000, right? Then once we subtract the cost price at beginning, this is just cost price at beginning, subtract cost price of sold, right? Then the difference should then be subtracted from, again, we need now to check accumulated depreciation of this set of equipment. So the accumulated depreciation at the beginning, how much was it there? 95,000. So in there we put in the 95,000, subtract accumulated depreciation of this particular equipment. The accumulated depreciation at the beginning. The accumulated depreciation at the beginning of the equipment is 32,000. Take that 32,000, you subtract it there as well. Then you can say times, what is the rate? The rate is 10% times, because they are remaining, it means we will be having it from the beginning of financial year until the end of the financial year. So it's a full year. Then when you do your working, the accumulated depreciation, subtract the cost prices there, or the cost prices minus the accumulated depreciation, and then times the rate of 10%, and then for a full year, it should give you your depreciation at 10,200 Rand. So that is your depreciation, 10,200 Rand. Then we move to the depreciation of the new. As per information, there was no new one. Then we move to the depreciation calculation of the sold. There was one sold as per information of the 12. The one that was sold, 80,000. So we start with the 80,000 as the cost price. Remember, there's a formula. Then minus accumulated. So minus accumulated of the particular, of this particular equipment. The accumulated depreciation was 32,000. So subtract that 32,000. Then we times it by the percentage, which is 10, times it by, for how long did we use it? They said it was sold on the 1st of, 31st of December. So from the 1st of March 2015 until December. So now we count from the beginning of the financial year until the date of sale. Then the months there is 10 months. Then the answer is 4,000. Right. So how much is the depreciation? The depreciation will then be the 10,200 of the remaining equipment, the 4,000 of this equipment sold. Then in total, it should give you 14,200 as your depreciation. That depreciation we transfer on our note, 14,200. Remember, depreciation is to be put in brackets because it's a negative asset. When we put it as accumulated depreciation, it's a negative asset. And then the depreciation itself, it's an expense. Right, so 14,200 is the total depreciation written off on my equipment for this year, so for this current year. Now, in the end, when we look into our information, land and building, there is no accumulated depreciation. Therefore, not plus that or not subtract that one gives you 850,000. Then now we need to determine our accumulated depreciation at the end. The accumulated depreciation at the end for vehicles, we will say depreciation there, 145,900, the one at the beginning, plus the depreciation during the year. So it's the one at the beginning plus the one during the year should give you accumulated depreciation at the end as 226,000. Remember, put in bracket, this one is negative asset. Then the cost price at the end. Cost price at the end will then be, or should then be, the 448,000 at the beginning, plus it with the additions, right? 448,000 at the beginning, plus additions of 180,000 should give you 628,000. Then the difference between these two, cost price minus accumulated, gives you carrying value. And then the carrying value is 401,400 rand. There's the difference between accumulated and the cost price. Now we go to the equipment. Under equipment, again, let's determine the accumulated depreciation at the end, right? We said the procedure is you take the one at the beginning, right, plus the depreciation during the year. But because there was a sold equipment, we need then to subtract its depreciation, right, minus depreciation of current year, of this year, right, minus depreciation of this year. Now let's check. It means we need to say 95,000. For this answer here, we need to say the 95,000 at the beginning plus the 14,200. Then remember, we've sold an equipment minus its accumulated depreciation of 36,000. Then in the end, you will then get your accumulated depreciation here is 73,200. And remember, if there's a sold asset, you cannot longer just say 95 plus 14,200 and put it in there. If there was no sold equipment, it's perfect. But once the element of selling an equipment comes in or kicks in, you need now to say the 95,000 plus the 14,200. Then remember to subtract the depreciation on the equipment for this year, and which was 36,000. All right. So the total is 73,200. Cost price. Cost price at the end is the cost price there at the beginning, 245,000. Right, the cost price at the beginning, 245,000, plus additions. There was no additions. Then we need to subtract the disposal. But the disposal must then not be, it must not be the 44,000. Very, very important. It must not be the 44,000. Remember, the 44,000 is a carrying value. You need now to go and check what was the cost price of this disposal. The cost price, as per information, remember, it was 80,000. So then we will say 245,000 minus the 80,000. Then we will get the answer of cost price there. If I can just show by an arrow, it means 245,000. We subtract it with the 80,000 in order to get cost price at end. So then the cost price at the end must amount or should amount to 165,000. Right? Remember, accumulated depreciation has to be in brackets. Then 165,000 minus 73,200 will give you carrying value. Then the carrying value is 91,800. Right? So when you transfer this information to your balance sheet, you will have to then add this line of the carrying value. Then that will then be what you put on your balance sheet. So this is how the fixed asset note looks like, which is to be prepared for the balance sheet. Then the next note to the balance sheet is then your creditors and other payables. Your creditors and other payables. Now the creditors and other payables. Again, look at this one. You are not given any items in here. That means you need to know your formats very well. Sometimes you are provided with the information. At other times, you'll just be given a blank answer sheet. You need to know what comes in here. That's why I'm stressing the importance of formats. All right, so we will use this question. 4.2, prepare the following notes to the balance sheet on 28 February. So the financial year ends 28 February, which means the start should be 1st March, then 2014. All right. So we need to do the trade and other payables. Okay. Now, remember, trade and other payables, creditors is needed in here. Then where do we get our creditors? Creditors come from the balance sheet section. So here we will write trade creditors. And why do we write trade creditors? Because there are other adjustments that might affect the creditors control coming from the trial balance. Then we must first consider them before we put a final answer there. Now in this case, let's look at our set of information. On our set of information, remember balance sheet section because creditors falls there. So when we look at creditors control, we have 47,400. And when we go through the adjustments, there isn't any other adjustments which affected the creditors. Now we can take that 47,400 as it is. Then the next item needs then to be as per the information. So we go to our information and check what else can affect my trade and other payables. When I look into the information, there we have creditors for wages, 12,000. It will most definitely affect my creditors and other payables. So creditors for wages, the 12,000 will affect this note. And next information, we check again what's in there. The pension fund. This is the fund account. It's a 3,000. It's a liability to us. So then we put it under the note, pension fund. Right? Remember, the employer's contribution and the employee's contribution together is taken to the pension fund. So the pension fund then becomes a liability to the business. So in there, it's 3,000 falling under trade and other payable. So it's an other payable, this pension fund. Then in our information, we also have SAS Pay as you earn. So the SAS Pay as you earn also fall under our payables. So SAS, the pay as you earn. Then how much is the total as per the information? It is 3,500. So we put it in there, 3,500. In the next item, we have so we've looked through all the information in here. Now we are left with our adjustments. We need to go and check any adjustments. If there are any adjustments which affected our creditors and other payables. When I look at the adjustments, adjustment number 11. No, wait a minute, let me just check. Yeah, adjustment number 11. Bought new equipment on 26 February 2015 and pay per check 45,000. So we are buying a new equipment and we spend 45,000 on it. Now it's important for us to go and check How much is our bank balance? No, we need to go and check how much is our bank balance from the trial balance. When we look into the trial balance, bank is under balance sheet section. So there's the bank. Our bank balance is 43,540. So our bank is on 43. Let me just check it again. Bank, yeah, 43,540. And this is a favorable balance because it falls under the debit side. Then now, we pay by check. We make a payment. Right? We pay for equipment. 45,000 goes out of this bank account. We pay. So in the end, when we look at the difference between the two, there will be a 1,460 difference. And this difference has ended up into an overdraft. So we have now an overdraft. We had money, but then we paid equipment with more than what we have in our bank account. Then the difference between the two ended up us having a overdraft. So this overdraft will then affect our creditors and other payables. So in there we will have bank overdraft. How much is that overdraft? 1,460. Then next, we need now to look at accrued expense and income received in advance, which is also one of the items that falls in here. But you will only know it if you know your formats very, very well. Right, then we look through our adjustments to check which adjustment will affect the trade and other payables. Number 7. Number 7, they say rent amount includes the rent for March 2015. Take into account that rent has increased with 7% as from 1 May 2014. Now what's important again, we need to determine the timeline. Remember, it's 1st March 2014 until 29 February 2015. When did the rent increase? They say we should take note that it increased on the 1st of May. So May should be somewhere there. 1st May 2014. It increased with a 7%. How much was this rent? We go to the trial balance and we check how much the rent was. Rent income is 55,080. So the total rent is now 55,080. But there's an interesting information where they say, take note that this rent, it includes rent from March 2016. Our financial year ends at 2015. So March 2016 should be there. 1st March 2016. And that is what the rent we've received is. So the 55,080, I cannot divide it by 12 or by 13 because we've received now 1 month in advance. We cannot divide it by 13 in order to see how much it was monthly because of this factor here. Now, means let's do it step by step. First step will be, let's check how much was the rent before. Let's check how much was the rent before the increase of percentage. So before, remember, anything before an increase is always 100%. So it means we received 100% for how many months? The increase was 1st May. So from March until before 1st May. So it will be March and April. So it's for 2 months where we received 100%. So then there it's 200. Then after the increase is 7%, which means it is now 107. Where does the 107 come from? It's 100 plus the 7, it gave us the 107. So there's 107 times. For how many months did we receive now this 107? It's from 1st March until, from 1st May 2014 until 1st March 2016, which is about 11 months. And multiply there. $11.77. So it's 107 times 11. So it's 11.77. Now add the two, 200 plus the 11.77. Wait a minute. Let's check again. It's 107 multiplied by 11. So it is 11.77. So 11.77 plus 200, it is 13.77. So this is our base. I normally call it just as our base. Go and check how much is the total of the rent which we received. It's 55,080. So the 55,080, I need to divide it with this 13.77. Then I multiply it by 107 over 1. Then it should give me then the amount of our rent per month before the or after the increase. So it's 55,080 divided by 13.77. Then we multiply it by 107. So it means it is 4,280, the rent after the increase per month. Now, how many rent did we receive in advance? We only received 1 month in advance for March, so we will take the 4,280 as it is, and it will fall under the trade and other payables as income received in advance. Income received in advance. And it amounts to 4,280. Right? Then let's look for accrued expense. On the information, adjustment number 6, the telephone account for February 2016 is still outstanding. It's 1,025. Now it means we take that one as it is under our creditors and other payables as accrued excuse me accrued expense. The accrued expense as per the information amounted to 1,025 because it's still outstanding. So that's 1,025. Right? Then let me just check. It looks like I've read now. A wrong one, sorry. Right, it's a wrong adjustment. It should be this one. The telephone account for February 2015 of 999 is still outstanding. Let me read again. The telephone account for February 2015 of 999 is still outstanding. All right. So there, it's not that one. That one is for a different exercise. The right one is 999. 999. That previous one comes from a previous exercise. Sorry for that. So the correct one is this one. The adjustment said the telephone account for February 2015 of 999 is still outstanding. So we slot it in there as accrued expense. So we have all the creditors and other payables, add them together, then your total in there should then be 72,739. That's then your total for creditors and other payables. This is what you will transfer to your balance sheet. This is what you will transfer to your balance sheet. Right, so that's the end of the creditors and other payables note. We've done the fixed asset note. All of those are informing your balance sheet. All of those are informing your balance sheet. Right. Then the next notes. We will have then now to prepare the capital note and the current account note. These notes are also notes that are informing your balance sheet. So again, I repeat what I said. Formats are very, very important. Formats are very important. So know the formats of these notes. Right. So this is notes based on the partnership. You have your balance at the beginning. Now all this comes from this exercise. Is still the November 2016 question form. Here you have David Pizzo and Simon Polisa. They are partners and they have PP traders as their business concern. And then what do we need to do? The note of capital, the note of current account. Then we complete the balance sheet. All right? So, set of information we need. Here they say balance at the beginning of the year for D. Pizzo and L. Polisa. When we look into our set of information, there's the 29th of February 2016, the end of financial year. We go to the capital. Under the capital, the date there is given as 29 February, 450,000. For Polisa, 29 February, 275,000. It means these balances are no longer balances at the beginning, but they are now balances at the end. Then, on our information, we will transfer them accordingly. Pizzo, at the end, we said is 450,000. We cannot put it as beginning. Why? Because of the date. Then Polisa is also now 275,000 at the end there. Now, let's go into our information again. Right, then information. Additional information, they say Deep Pizzo decreased his capital account by withdrawing an amount of 50,000. This was properly recorded, which means the decrease was recorded. That's why in the end we have now 450,000. So that's a withdrawal. Put it under withdrawal, 50,000 in brackets because it was a withdrawal. Now once I have this and my balance at the end, to work up, I am now able to get balance at the beginning. I will just have to add these two then. Then my balance at the beginning amounts to 500,000 for my capital. Right? So I will have to add, because when I moved down, I subtracted 500,000 minus 50, gave me 450. So I have the 450 and the 50,000, but I do not have the 500,000, so I'll add these two to get that one. Then L. Polisa. L. Polisa, what happened to his capital? L. Polisa increased, so there's an L. L. Polisa increased his capital contribution by giving equipment valued at 85,000. This was on 31st January 2016. This was also properly recorded. That's why we have that kind of a balance at the end. All right? So this was additional. So we put under additional. How much was added? An 85,000. Right? So 275,000 I have as balance at the end, and I have additional capital contributed, but I do not have my balance at the beginning. So when I worked down, I added whatever I had at the beginning plus the 85,000, it gave me 275. Now I need to work back. I will subtract the two. Then I will have my capital at the beginning as 190,000. So that is the capital note. Then now we move into the current account note. The current account note, actually both these two notes is the same as the leisure accounts you've prepared. It's just now they are expressed in a form of notes. The procedure is still the same. So now we look into salaries. When we read into the information, S. Polisa is entitled to an annual salary of 72,000. So under Polisa, we take his salary, we put in there 72,000 is what he is entitled to. Then, what is the salary of Pitso? Salary, there's D Pitso. Salary of Pitso is 2,400 per month, more than the of Polisa. Now Polisa is getting 72,000, right? So we divide it by 12 so that we can check how much is it per month. So if you take 72,000 and you divide it by 12, you have a 6,000, which means the salary of Polisa per month is 6,000 per month. Now, Pitso is getting 2,400 more. So we add it, then when we add it with the 2,400, it means Pitso is getting 8,400. This is for Pitso. Now, because we work with a 12-month period, we need to multiply that by 12. So multiply then by 12, we will then see that Pitso is actually getting 100,800 rand. So that's the salaries. Now interest on capital, that's retail information what are they saying. They say interest on capital for Polisa is 23,650. So under Polisa, it's 23,650. Let's read the interest for Pitso. Interest on capital at 12% per annum on his capital contribution for the year. Now the examiner makes us aware that consider the movement during the year. The movement of what? The movement of the capital. So when we look at Pitso's capital, at the beginning Pitso had 500,000. Then he decreased it by 50,000 to 450,000. So now we need to work out the interest on capital. So the interest on capital will then be calculated on two sections. The first one is before the decrease, right? Before that movement. So before the movement, he had 500,000. Multiply by what is the percentage of the interest? The percentage of the interest is 12%. So multiply it by 12%. Right, so multiply by 12%. Multiply it by, for how many months did they have the 500,000 before they decrease it with a 50,000? The decrease happened on the 31st of May. That's when the decrease happened. So from March until May, it's about 3 months. So 3 months, how much is the interest there then? Then the interest should then be 15,000 when you work it out. So there's the interest before the decrease of the capital. So here I will show in my workings, I have a 15,000, all right? Then something happened, we decreased. So leg number 2, it's after, or calculation number 2, it's after the decrease. We no longer, or he no longer has 500,000. It's now 500,000 minus that 50,000, remember. So which makes his capital 450,000 now. So the 450,000 multiplied by the percentage remained the same times for how many months was it now on that? It's for about 9 months. Right? So it's for about 9 months. How did we get the 9 months? It's now after that decrease on May. You start after May counting towards 29 February. So it's 9 months. Then that 9 months, when we do the working there, you should have then your interest on capital is 40,500. Then that 40,500 plus the 15,000 should be the total of your interest on capital. 40,500 there. Add it together, the total for the interest on capital for Pitso should be 55,500 rand. Right. Was there any bonuses? When we look into the information, an annual bonus of 10,000 for who? For Palisa. So under Palisa, we put he has received a 10,000 bonus. All right. Then was there any bonus for Pitso? No bonus for Pitso, so it's a 0 there. Now, the primary distribution. How do we get the primary distribution? The primary distribution is the total of your salary, interest on capital plus the bonus. It will give you primary distribution. So when we add up everything there, we have 156,300 rand. And when we add there, it's 105,650. That's the primary distribution. Then now from the primary distribution, we move to the final distribution. Now, what are they saying about the final distribution? Let's look into the information. They say the final distribution, number F, remaining profit must be divided in the ratio 2:1 between Pitso and Polisa. The remaining profit. The keyword there is remaining profit. Did they give us remaining profit? Let's now look for our profit. In information number D, they said the net profit for the year was. Now there the keyword is, this is net profit for the year. What are we looking for? We are looking for remaining profit. Now if that's the case, then we need to say, okay, net profit, we need to take the net profit, which they said is 291,950. So 291,950. Subtract your primary distribution. And the primary distribution must be of both partners. Both partners. The primary distribution of both partners. Right? So the primary distribution of both partners, it is these two together. The 156,300 plus the 105,650. Right? So that is the primary distribution. So it amounts to 261,950. Now subtract it from the net profit of 291,950 minus 261,950. What's remaining there is now a 30,000. This is our remaining profit. Remaining profit. Now this profit has to be shared. How? They clearly indicated for us what's remaining. Share it in the ratio 2:1 between the partners, Pitso and Polisa. The first digit goes to the first partner. The second digit goes to the second partner. Then the sum of this ratio is then 3. The total is 3. The total is then 3. Now let's start with Pitso. We will say 30,000 multiplied with, how much is Pitso getting? 2 out of the third. So 2 over 3, he will get his portion. And then Polisa, again we take 30,000 multiplied by 1 over the 3, which is the third. Then it will be as follows. Pitso will get, when you work out there, it should be 20,000. And then Polisa will then be 10,000, right? So we transfer it accordingly. The final distribution, Pitso will get from the remaining profit a 20,000. And then Polisa a 10,000, right? Then now the net profit for the year, we add primary distribution and the final distribution together, right? When we add it, it's 176,300, right? And then with this one is 115,650. Now normally in other formats, this section comes on top, but it doesn't matter. So with the alternative which they give on the next page. The difference is that net profit part comes there on top. But the procedure remains the same. That net profit comes there on top. But the procedure remains the same. On this format, the net profit is there immediately after the final and primary distribution together. Then we look for drawings. The drawings, we have drawings on the information. They say, sorry, right. They say drawings. Where is it now? Pitso withdrew on the 27th February additional cash to the amount of 1,500. This transaction was not recorded. Now let's look at the drawings of Pitso. Pitso's drawings is 87,950. So I'll open bracket and say 87,950. He withdrew another 1,500. So plus 1,500. It changes now that drawings amount to, when you add them together, when you add these two together, it changes the drawings to 89,450, and we must put it in brackets. So it has completely changed the drawings for the year. Then let's look at the drawings for Polisa. The drawings for Polisa, 78,000. When we look at the adjustments, there was no adjustment affecting that, so we write it as it is, 78,000. Put it in brackets because it's drawings. Right? So the net profit minus the drawings will give us an amount there of 86,850. Minus these two will give you 37,650. Now the balance at beginning of the year. What balance at beginning for the year? It's the balance of the current accounts. So you now need to go and look into the information. Where is your current accounts? Current account, we have current account of Pitso, 1st March, so it's the beginning, so it's at the beginning, 1st March. It's on the credit side, 15,565. When it's on the credit side, remember, it's a favorable balance then. So it's 15,565. It's a favorable balance. Then the balance at the beginning for Polisa, current account balance for Polisa, 1st of March. Very important to look at the dates, because sometimes if the dates are not there here, then it means these balances are for at the end. These balances are then for the end. But there, they highlight to us its balances at the beginning. So 7,450 on the debit side, immediately you need to know that it's now an unfavorable balance. So it's 7,450, put it in brackets. Right. So when we add these two, we'll get balance at the end of the year. So it's 102,415. When we now say 37,650, 37,650 minus 7,450, it gives us 30,200, and the balance is favorable at the end. So that is the note on your current account and the note on the capital account. This goes to your balance sheet. Then the last section will then be the balance sheet. So on the balance sheet, we can start from the equity section. Again, format is important. Then on the balance sheet, we can start from the equity section. Right, these sections are not needed. We've done them, so we don't need them for now. Now it means we can go to non-current liabilities. Non-current liabilities, we are to look for we are to look for the loan the mortgage loan, as per information, the mortgage loan there, it's 180,000. So we start with that figure. The loan or the bond amounts to 180,000. Then adjustments. When we look into the adjustment G tells us an amount of 15,900 must be paid as repayment on the mortgage bond to Zamdela Bank during the next financial year. So this is what has to be transferred to the current portion of loan. So it's minus 15,900. Then the difference between the two is then what the mortgage bond is at the end. 164,100. 164,100. That's what the mortgage bond is. Then from there we go to our current liabilities. Under current liabilities, we have our trade and other payables. Trade and payables. Open bracket. Remember, we start with creditors control. In the information, creditors control is 78,100. So let's check again. On the information, creditors control is 78,100. So we will say 78,100 plus, we need now to look for, we have accrued expense as 5,750. We put it in, plus 5,750. Then plus, we look for income received in advance. We have income received in advance in the information as 1,550. So it's 1,550 there. When we add everything up, we will have a total of 85,400. That's the total there. Then the next, we will look at a bank overdraft. It's there, right? So bank overdraft is there. So we'll take bank overdraft. So bank overdraft, open bracket, we have 4,650 as per the information. Then remember adjustment number C. Picho withdrew money. He withdrew money, 1,500. So you have an overdraft and you go and withdraw again. It means it will then increase your overdraft. It will increase your overdraft, 1,500. Then the total should be 6,150. 6,150. So 6,150. Then remember, this portion is a repayment or current portion of loan or short-term loan. We need to put it under the current liabilities as 15,900. So when we add all our current liabilities, we'll have a total of 107,450. Right, so this part is our current liabilities part. This is our non-current liabilities part. Then we move to our current asset part. The current asset part, we should have in there our inventory. So inventories, when we look at the information given to us, there's nothing about inventories. So inventory will then be my balancing figure. It will be my solve for X, my balancing figure. Then trade and other receivables, trade and receivables, open bracket, we start with our debtors control. So when we look in the information, debtors control, 37,300. Let's check again, 37,300. So 37,300, right? Then we need to plus accrued income. So when we look at the information, accrued income is 4,760. So 4,760 there. Those were the only two. When we add them, you have then 42,060. 42,060 is your total there. Then next, we'll have to write cash and cash equivalents. Cash and cash equivalents. Look for petty cash, bank, cash float. So open bracket to do the working. In the information, we have cash float 3,300. Then plus our bank was overdraft, there's no petty cash. We go and look at the additional information number H. They say the financial assets of 75,000 at Paris Bank consist of a fixed deposit, one of 45,000 which matures. So when a fixed deposit matures, that portion falls under cash and cash equivalents. So it goes in there, 45,000. And when we add the two together, it will then be 48,300. Now still, I cannot get my inventories. Now I need to use another method. Current assets I also do not have, because if I have my current assets, I can say current assets, subtract my cash and cash equivalents, subtract my trade and other receivables, then I'll get this answer of inventories. But I know on my ratios, we have a ratio which is called the liquidity ratios, where we look at the current ratio. It says current assets is to current liabilities. Now, on the information, we are given the current ratio. The current ratio is 1,1:1. So we have our answer here is 1,8:1. The current assets I don't have, but the current liabilities I have is 107,450. Now I divided these two to get this answer. So now I can multiply these two to get this answer. So I can now say multiply by 1,8, then I will have my answer for my current liabilities as 193,410. So I multiplied my answer of current ratio with my current liabilities to get my current assets as 193,410. Now once I have it, I can now say that 193,410, subtract my trade and other receivables, subtract my cash and cash equivalents. What remains will then be my unknown figure of inventory, which should be 103,050. So that is how the balance sheet concludes, especially when they just ask you to complete certain portions. But if they ask you to complete a fully fleshed one, you will have to also answer the other items which comes in there. So most importantly, your formats, you need to know them. And secondly, your timeline, never mix it up. Then boys and girls in grade 11, as you prepare for your final examinations, I hope that you will do your best until we meet again. Thank you.